Hey everyone, Value Add Mike here today to discuss the breaking news of the interest rates going up. So it could be 75 basis points, it could be 100 basis points, but really all it is recalibrating our debt. So for those who don't know, my name is Value Add Mike Taravella. I've closed over 60 million in commercial real estate, specifically in multifamily with my partners. And today I wanted to discuss real estate. So over the last couple months, people have been freaking out about interest rates going up. I'm waiting for the downfall, the recession's happening, and there's just a lot of chaos. And Howard Marks said it best: people are quick to forget. So looking at interest rates now comparative to where they were, people were buying homes 20 plus years ago with 17% interest rates. So the 10-year being at 3%, even 4%, it may be alarming if you look at the small scope of 2022 and comparing it to really low interest rate environments of 2020 and 2021, but it is okay. We just have to look at the deals a little bit differently and making sure that we understand what's happening and if it's still a good deal. So when looking at the deal, first thing I'm looking at is the interest rate. And even when I'm underwriting about 200 to 250 basis points higher of my interest rate, and just making sure that I understand, can the interest rate, if that changes when we're under contract, does it still look like a good deal? The second thing and especially if you're under contract right now and the rates change, making sure that you either have it locked in, or if it changes, that you can stomach the change. If not, you may have to go back for a price negotiation. But as a limited partner, I would really highly suggest getting in touch with your operator. I'm sure they know the news that's happening, but making sure that they have a proper game plan to execute the deal with the debt. The second thing that I'm looking at is looking at the debt service coverage ratio. So with interest rates going up, lenders don't like to lend as much because they said that your debt service coverage ratio is a little bit higher, or is lower, because your interest rates go up, so the cost of the money increases, so your cash flow will go down. So it's just super important to make sure that you're not only discussing the interest rate with your lender and operator, but also your loan to value or loan to cost. So it's super important that you're not only discussing the interest rate, but your loan to value. So knowing those two things are super critical when you're looking at deals. Just want to remind you, the world is not ending. We just have to look at the deals in a little bit different lens. That's why I'm looking at deals of 60 to 65% loan to value, maybe even lower if it makes sense. This is why loan assumptions are much more attractive in the market, because you can still achieve that lower leverage deal, but you may get a more attractive interest rate with that were in the 2000s and 2001s of 3%. So, and it's just a matter of negotiation and understanding where we are in the market cycle, and just understanding that with rising interest rates, loan assumptions are becoming more normalized, and also you may have to underwrite with lower leverage. But check your operators, check your lenders, and just making sure that you're having a game plan for when the rates go up. And until then, we will see you next week.